All right, Jaeden, I am so glad to have you back. Your first episode with us was fantastic here with Adams Wealth Advisors. I have another conversation that I wanted to have with you, and I'm excited to get into this because we get this conversation all the time. So thank you for being here again.
Thank you. I'm excited to be here. It's
Yes,
always
and
a good time.
it is always a good time. And I think our viewers really appreciate all of the wisdom that you bring here. So, real quick, I'll kind of give the preface. This video is going to be about the question that we hear all the time of somebody comes to us and says, when can I retire? And it's such a loaded question. And I think a lot of people want you to tell them exactly this, or you have this amount of money. But we're going to get into why that isn't necessarily the case. So, if I come to you, Jaeden, when can I retire?
That's the winning question, right? I think we all wonder it for ourselves. When can I retire? Really what it comes down to is how much can you live off of? I think there's a lot of people that could retire if it really came down to it, but they might not be living the lifestyle that they're used to and that they're accustomed to. So it is a loaded question, and there's more to it than even just the spending side. There's the tax implications. There's the insurance, health insurance side. Health expenses are huge when it comes to those latter years. So there's a few different aspects that we can tackle to hopefully come up with a more well-rounded approach to that question.
That's awesome. And let's maybe move even into retiring early. And what is, because we get that asked too, I want to retire early. Well, what does early mean to you, and what does early mean to a lot of your clients?
Yeah. So early to me, if I have a client that is wanting to retire before they've reached full retirement age for Social Security and before they're on Medicare, then that tends to be when the red flag goes up for, okay, this is an early retirement that we're probably going to have to plan for a couple of other things that you might not have to plan for if you've already gotten on Medicare and, you've reached your full retirement age. With that, if you're retiring before age 59 and a half, there are some very important things that you need to keep in mind, because most retirement plans are structured to where distributions are not allowed unless you were assessed a 10% penalty if you're not 59 and a half. So that's a very important age to remember and to plan around. The reality is, though, sometimes we can't plan. Sometimes there are things and unforeseen circumstances that you don't have the choice and you're pushed into retirement at an earlier age. So we'll talk about a few things that you can do to still optimize your retirement plan, even if it's before that magic 59 and a half number.
And when you talk about 59 and a half in these accounts, are we talking IRAs, 401ks? Like, what magical accounts are revolving around that number?
Yes. So the term is qualified accounts. Qualified accounts such as 401ks, IRAs, many pension plans are qualified, have that 59 and a half number attached to them. Roth IRAs are another one. So very important to be aware of that if you're considering retiring before then. And a lot of people, maybe it's not a full retirement, but maybe you don't want to be working 40 hours a week, 50 hours a week in your 60s. And if that's the case, we'll still have a similar conversation on how we can tailor a pre-retirement plan or a semi-retirement plan around that age.
That's perfect. And we're in the healthcare space. So you brought up the healthcare side of things and pre-Medicare. I mean, your options are an employer plan, but if you're retiring and you don't have access to that, you're going on to a marketplace plan most likely, and depending on your income, that may or may not be expensive for you. So
yeah, and I think it's not as bad as some people think. At least I've had many clients that have been pleasantly surprised when they've entered into retirement, whether it was planned or unplanned, and they're needing to get insurance before age 65 and get on the marketplace. And there are some really great options out there. So I don't think that that should be the sole reason, right, that you're waiting for retirement. And I hear that a lot. So many people that it's, I'm here, I have plenty of money, but I'm here till 65 because of health insurance. And if they took a step back and looked into their marketplace options, they might realize that it really might not be as bad as they might think. And in some cases, it could even be cheaper than their employer plan.
Yeah, for sure. Medicare is a similar fashion of a lot of people don't go on Medicare because they're working. And sometimes Medicare is better and cheaper than their employer plan.
Exactly.
I think this comes a lot too when one spouse is maybe eligible for that and the other is younger. So there's that age gap, and so they're afraid to make those transitions, not knowing what the marketplace really looks like.
Definitely. Yeah, and there's also a few things to do. The marketplace is based on income. So there are some planning opportunities around keeping income low in those first few years of retirement in your gap years so that you can qualify for the health insurance. And so there's some planning with that.
I want to dive into that because we've talked about this on other episodes of stuff of when you retire. Let's go the other way. Pre-retirement, you don't have as much control over your income, especially if you're in a W-2 job. your income is kind of there, and then you
Mm-hmm.
deal with the tax consequences of that. Once you go into retirement, you have a lot more control over how much income you're pulling and from which accounts you're pulling. So maybe you can dive into some of those tax advantages of certain accounts when you're retiring earlier and just in
Yes.
general.
I call it tax diversification. And I think we're all really familiar with investment diversification, and you hear it all the time. I mean, it's hammered. Stay diversified. Make sure that you're not putting all of your eggs in one basket. And I think it's so underrated I think that we overlook far too often that the same principle applies inside our type of accounts and the tax treatment inside each of those. So yes, there's a lot that goes into it, and I think that it's more than, people, you work at a job for 30 years and you park money into the 401k and it's automatic and it's taken care of for you. And so it's really easy to maybe not think about or not realize that there could be some problems with only having your money inside of a traditional 401k. And when you go to pull that out in retirement, every single dollar that you pull out of there is taxed. And so there are some strategies where we can create some other types of accounts so that the tax hit isn't so hard and that isn't your only option when you hit retirement.
What options do we have? So let's say, and mine wasn't retirement, but I left a job, I had a 401k. I guess I could keep it with the same custodian with that 401k, or I can move it. So what options does
Yes.
somebody have let's talk specifically with 401ks and then we can move
Mm-hmm.
into others, but with an employer sponsored 401k, what are their options once they have that available?
Yes. So your options are leave the assets inside the plan and they can continue investing in whatever strategy you had outlined. And you still can take distributions from an employer plan just as you would if you transferred to an IRA. But it still will be tied to the employer. It's still inside that employer plan.
And sometimes it seems like the employer picks up the administration fee when you're employed with them, and then that goes away when you're
Very
not
true.
employed. Is that accurate?
Yes. Yeah. And fees inside those employer plans, they aren't always the easiest to find. And they do their best to disclose things. I think this is the same for the entire investment industry, right? It's very hard to really dig into there, and it can take some time of finding statements and really digging into what you are being charged on those. But it's absolutely worth analyzing that and seeing what options do I have, not only from a fee standpoint inside the 401k, but what investment options do I have? Because they're often limited to a certain criteria or a certain outline that they give you. Here's what your investment options are. Pick one, or
Hmm.
mix and match these. And if you're someone that maybe those don't fit your financial plan, or you're needing more than just set it and forget it, then a more active approach, then that's when an advisor could come in and you can roll those assets out of the retirement plan and fund an IRA.
Hmm.
So depending on if those assets are traditional or Roth, you can roll those over into a traditional IRA and a Roth IRA. At that point, ties are completely severed with the employer. This is in your individual name. You'll list your own beneficiaries and it's your account, and you have full control over what goes on with those assets.
And there's no limit on that, right? If I've got $1 million 401k, I'm okay to roll that over into an
Yes.
IRA with no
Yep. If
problem.
you're severed from the employer at any time, you can make that move over. You do have an option to make an in-service rollover while you're still employed, depending on your plan. So some plans allow you, if you've reached, and they usually set an age on it, that, if you've reached 55 or 59 and a half, whatever the number is, that you'd be able to move some assets out of your 401k and into a traditional IRA, even if you're still working there. And that's definitely something to look at to see if it could enhance your plan. But for most people, when they sever ties with the company, that's when they come at the crossroads of this decision.
Does vesting come into this conversation at all? I mean, I think we're talking about people who've been with an employer for a long
Yes.
time, but what if you haven't been with an employer for a long time? Where does vesting come into
Yes.
play?
Yeah. So vesting is a schedule that the employer will match your contributions. And typically they'll say, hey, you need to work with us for X amount of years before we'll give you 100% of the value of your contributions. So that does come into this when you're making the decision to potentially step back from an employer. I had a client that I worked with, this was a few months ago. They were actually laid off from their job, and it was 2 months before their contributions were vested. So they hadn't been there very long, but they finally hit that. I think it was their 2-year mark. And almost hit their 2-year mark and they were let go, and we were digging into the plan, going to make the rollover. Only a portion of the assets actually rolled over into the plan. As we dug into it, not all of the assets were vested. So definitely something to be aware of, but that would have to come into account before you make the decision to retire. Because once you sever with the company, leaving the assets in the 401k won't help your vesting. You have to be actively working with the 401k or with the company.
Yeah. I like what you talked about of moving that 401k. Again, you have not a lot of control over it if it's in the company plan. And then again, whether you've moved on to something else. And if that is an advisor, fantastic, but it seems like you have a little bit more control over what's happening there. What about moving from, let's say your 401k was a traditional account and now you're in a traditional IRA? What does that process look like to move that from a traditional to a Roth? Again, there are fanatics on both sides. We've got videos that have gone crazy on this, but some people vehemently believe in Roth. Some people feel the exact same passion about a traditional. What does that movement look like between those accounts?
Yeah. It's very easy to move in between accounts. The biggest thing is don't move before you've done the planning, because you're right. There's so many different resources out there. You read one article and it's a no-brainer. I need to move this whole account tomorrow. You read another and it's, hey, I need to die with this money in this traditional. I should never move this. So, and I think it totally depends on the person. And again, you've had some other videos that have explained this really well, because each person is different. It comes down to life expectancy, lifestyle, so many different things that come into this decision. But when it comes to formally making that Roth conversion or making a transfer from a traditional IRA to a Roth IRA, I usually don't process these transfers for my clients until we get a little bit closer to the end of the year, just so we don't have room for surprises to pop up in the year. Because once you make that transfer over, that's taxable income. So make sure that you're working with an advisor and a tax accountant to really map out what your income for the year will look like, and then make that Roth contribution or Roth conversion to maximize the long-term plan and tax savings overall.
Tax is such a big topic for people, and I'm going to let you dive into it. The preface of this question is, so many people hate paying taxes, which is fine. And it seems like they will make decisions on how can I pay the least amount of taxes this year, even though that hurts them in the long term, that will eventually pay more taxes in the future. So what are kind of our tax options? We've talked Roth and traditional. Are there any other tax diversification strategies that we can figure out for those who are wanting to retire?
Yes. So there are 3 different types of accounts that I primarily work with, or just basically types of tax treatment when it comes to investments. So the ones that we've talked about, traditional, Roth. There's also a taxable investment account. So I think it's a very underrated type of account that people forget about. And a taxable investment account is not sponsored through an employer. This is a type of account that is essentially taxed and treated. It's the exact same thing as your bank account. The difference is that bank account is probably not generating a whole lot of interest. You're not buying assets with it. But inside that same account structure, you can open a brokerage account, a taxable investment account. It can be in your name, in the name of your trust, joint with a spouse, whatever it is. And you can buy assets through there. The benefit of the taxable investment account is there's not restrictions on it like there are with qualified retirement plans. You could pull the money out the next day if you really wanted to. There's no age limits that you have to be aware of. From a tax standpoint, there aren't tax incentives when you put money in. You're not getting a write-off by putting money in. But the benefit with the taxable investment account is that as you put money in and you buy long-term assets that are appreciating, usually what I do with my clients is we try to time this up to where we can accumulate long-term capital gains treatment. Instead of recognizing ordinary income on distributions from a 401k, you can ease the tax burden by pulling money out of this taxable investment account, where only a portion of it is taxable as you make a distribution, and it's taxed at better tax rates, long-term capital gains usually.
For a long-term capital gains rate, is there a time limit? Is that more than a year? Is that longer than, how long is a long-term capital gain?
Over a year. You have to at least hit the 1 year mark. So 1 year and 1 day, and then you can sell those assets and get the long-term capital gain status. If you don't, now you're looking at short-term capital gains, which are typically ordinary income.
Gotcha. It's funny because this was a few years ago back when kind of COVID was hitting, and I was in Robinhood and I was just messing around with like Dogecoin and Shiba because it was so low. And then if you remember, like this is not an endorsement for crypto at all, but there was this huge run on all of that stuff that went crazy. And so I got a text from my brother who's a financial whiz, and he was like, "Hey, how long have you had that? Like be careful cashing out because there's a difference between how long you've had those assets." And it sounds like whether that's crypto or stocks, it was a year is kind of what
Yes, and
was
same
looked
thing
at.
with real estate, same thing with most investment vehicles or most investment assets, it's gonna be the same thing, and it's a big difference. You can actually recognize for many families, there's a wide range of income in the capital gains tax rates that you can recognize at 0%.
Mm.
So you could potentially make a sell inside your investment account and have tax-free income from that. And then the next jump is 15%, which is a lot more enticing than the 22%, 24%, the other tax rates that most people are used to working with on the ordinary side.
Yeah, I think this goes back to your point of like you're able to control your income much better later than in a specific given year while you're working.
Yes.
What other things are there, like side hustles or other things that people can do once they've officially retired that can also bring them income in a maybe a tax advantaged way?
Yes. Yeah, I think the side hustle is very valuable when it comes to financial planning and sometimes overlooked as well. That some people think that, "Oh, if I'm only earning, maybe a few $100s a month or a couple $1,000s a month, is it really worth it to receive the income?" But when it comes to retiring early, one of the biggest risks is that now we widen the range of outcomes because you have more years that you're not saving anymore and more years that you're spending. So by retiring early, this can create some more risk in the plan because we have a longevity risk. If you live a really long time, we have more years that we need to plan for and more outcomes that could come when it comes to investment statistics and when we stress test your plan. So getting a side hustle and having some part-time income has a really dramatic effect on the long-term output of a plan. And so even if it's a small amount, it's less money that you're having to pull out of the portfolio. And when you look at time value of money, it makes a big difference. When you can leave those dollars parked for another 5 or 10 years, it's huge. So I'm a huge advocate for it. I think not only for just from an income standpoint, it's beneficial to have more money coming in, but also mentally when people enter retirement and especially retiring early, I think that it is very valuable to have something that you're still, getting up and going after and
Yeah.
something that you can look forward to.
We have so many people who will retire and they're saying, I'm looking forward to sleeping in, or I'm looking forward to
Yeah.
golfing or to going to whatever. And then 6 months in, they're like, I'm bored. Like, I
Never
don't,
mind.
yeah, I don't know. I don't know what I'm doing with myself. So I think the side hustle is great. YouTube is a
Yeah.
great thing. If you know a skill, jump on
It
YouTube.
totally is. YouTube, DoorDash. Yeah. Yeah,
Yeah.
I see it all too often. Especially, I think that retirees don't realize, retirement is a big life transition. And so is marriage and having a baby. And we try to prepare people as they enter these life transitions. But I think that retirement can sometimes get forgotten because it is built up as this big, exciting life transition. And I see a lot of people that enter that stage of retirement before they got a lot of value and self-fulfillment by investing in their 401k and seeing that account balance go up and providing for their family. And even if they didn't like the day-to-day job that they were doing, they did get some fulfillment just out of the push towards the greater goal. And there is this mentality shift when now you're spending the assets down. And now we enter a different territory that I think it takes people sometimes a couple of years to figure out what their new driver is going to be and how to still have those goals and ambitions when it isn't inside working anymore. So that gets skipped over. I think it would be very helpful for people to think about that aspect of retirement on top of the financial side. But yeah, one day you're going to be spending these assets down, and for a really long time, that was like your only goal was to never pull out of these.
Mhm.
So
That-
it's a huge shift.
Psychologically, that's really hard. There's The Psychology of Money, which is one of my favorite books in the whole
Awesome
world.
book.
But he
Love
talks
it.
about that, he was like, man, the example that I always thought was, it's an example of this is really cool, but I was like, oh, I don't know about that. I think it was a janitor and he had saved all of this money, he had like $6 million when he died, and he just lived so frugally, which is great, but he was afraid to spend down anything and he was afraid to do to live off of those things. So I think
Yeah.
that psychology shift of, okay, I can't spend anything for so long, and then now I have to spend it and see that go down is hard for people.
It definitely is. Yeah, there's a lot of fear with it that I don't think people plan for that. They plan for the celebration that you hit retirement and now, yay, you don't have to go to work anymore. You know, it's this big party for that first little bit after retirement. And they don't plan for that fear that usually sets on them at some point of, oh, whoa, this is changing my whole life. I mean,
Yeah.
my day to day is completely flipped upside down. So
What
definitely
about
good.
those 59 and a half, that number with those accounts? Is there anything, I don't want to call them hacks, but are there things that are within the realm of the rules where people can still access some of that before 59 and a half?
There is.
Okay.
Yes. So there are two main ways or loopholes, if you will. And they're, solid loopholes. The tax code supports them to pull money out of your retirement plan before 59 and a half without getting assessed that 10% penalty. So one of the ways that I see this is the rule of 55. And some employer plans will implement the rule of 55. It's basically language inside a 401k plan that if you retire at 55 or at or after 55, they'll let you pull money out of there without the penalty as long before you've reached 59 and a half. You can pull that from there as long as you were retired from that company that
Is
you
that
had
like an
that
incentive
401k
for them
through.
to get people to retire early?
Yes. Yeah. So I see this usually with very large companies that often they'll offer those payouts for the retirement packages to wish people out the door and give them some options as they head out. So that's usually where we see it. But that's a really good way to get out of that 10% penalty. Not all plans allow for them. I've ran into it more often than not that the plan doesn't allow for it. So then we have to pivot to the 72T election. So the 72T election is a way to get money out of the plan without penalties. How it's calculated. So basically, and you'll work with your accountant, there's a few different ways to get down to this. So it can get very complex. But basically, the government's provided a loophole that says if you will distribute some of this money in equal periodic payments, we will not assess that 10% penalty anymore. You don't get to decide what that number is for their equal periodic payment. So you have to work with your accountant, plug through, they use midterm AFR, pull together the number that you need to pull, and now you are obligated to pull that amount of money from your 401k or traditional IRA over the next 5 years or to age 59 and a half, whichever is longer. So the earlier you retire, the longer you'd be required to continue making these payments up until you reach age 59 and a half to yourself. Basically, they want money to come out of these accounts to get some tax out of it. The tax is assessed on it. So it's their way of making a deal that, all right, if you pull this out over the next 5 years or till 59 and a half, you'll pay some tax along the way. But in trade for that, we won't assess that 10% penalty.
With accounts, whether it's traditional or Roth, am I able to pull out the initial contributions before that age, or is it I can't touch anything before 59 and a half?
Yes. So inside a Roth IRA, you can pull out your initial contributions. Traditional IRA, you're out of luck. But yes, the Roth IRA will give you some more options. So having a Roth IRA, a traditional IRA, and a taxable investment account, if you have all of these vehicles to look at as you approach retirement, as you approach the gap between your retirement and potentially Medicare, it's good to have these different buckets to pull from so that you can keep that income low and not be, stretched in making sizable distributions to satisfy a 72T requirement just because your only asset is your traditional IRA.
Yeah, no, I think that's that diversification that you kind of started this all out with. I want to go back to that Roth thing again because I genuinely have questions around that too of how do if I want to take out the contributions I've made and it's been an X number of years, how do I say like, okay, that was a contribution versus that was a gain?
Yes.
Am I just tracking the dollars that I contributed and I can pull out that dollar amount, or is it a specific investment of Does that make sense?
Yeah.
Or does that not make sense? If I put dollars in, it bought investments of some sort. How do I point to that was a contribution, not a gain?
Yes. So when you invest in a Roth IRA, you receive a 5498 tax form every year. And so the custodian that holds that Roth IRA, they'll calculate how much of that of your Roth IRA is composed of your contributions versus growth. They'll give you a form that says, here's how much you contributed this year. Your accountant now will back that into your tax return, and your accountant will keep track of that running total so that when it comes time to make a distribution, you have a good tally on that. Now, do you think most people do that? Probably not.
Yeah.
I mean, it's, one of those things that you don't plan on needing to make a distribution. It comes up usually, later, but there are really good accountants that will back into it. You'll go through previous tax documents and find your statements to find out where you're at so that you can make those distributions. But you'll track that through your accountant or when you file your taxes.
Perfect. I think this might be even the most important part of this conversation that we talk about, because you mentioned it at the beginning, but I want you to walk us through that conversation that you have with your clients of when they come to you and they ask, when can I retire? I mean, it is, what is the lifestyle that you want to live, right? I mean, like, what kind of expenses do you have? Is a house paid off or not? And so when you go through that conversation with somebody, what is encouraging? I think, what would people be surprised by the most when they come to you with that question of, am I able to retire or not?
Yeah, it is a loaded question because I think they are looking for that simple answer. I think they would be surprised with how complex it is to get to that answer and how much planning it takes to really dial down a plan that has been stress tested to know that you are safe to retire on this amount. With that being said, a lot of people, you figure it out. A lot of people don't go through the planning and they still manage to make their way through it. But there is a peace of mind that comes from having the plan in place so that year over year, we take a very disciplined approach in sending them that income. When they're making that shift, that mindset shift from saving to spending, it really helps when they already have that plan in place. They've already executed the plan to get to this point, and it's a disciplined approach on here's what I'm spending and here's where I'm at. Things are going to change, and we'll pivot for that when it comes. But I think people would be surprised at how many factors go into that, right? Not only the tax and the spouses and kids and unique circumstances, but the mentality of that switch, making sure that we create a plan that works for them.
Yeah, and it seems like, you can maybe correct me if I'm wrong, it seems like the mentality of I'm shooting for a number, like I want to retire with $2 million or $10 million might not be the right approach, because having $10 million for the lifestyle that Jeff Bezos lives probably isn't going to last very long, but $10 million for the lifestyle that I live will last forever for me and my kids. So
yes,
I think that target of a number may not be the best
Definitely.
way to approach it.
Yeah, the closer you are to retirement, the easier it is to pinpoint what that number is. And we can hone in on a number more so. The farther out you are, though, there's so much risk of mostly just your lifestyle changing, because I see it when we're building a plan for someone that is 20, 30 years out from retirement, we'll make some conservative estimates, but the reality is life changes, you get promotions, you get raises, your lifestyle increases with that throughout your life. And so we'll build an inflation buffer in there and we'll add some growth in there so that we can make some conservative estimates. But until you get a little bit closer to retirement and you're right around the corner from that decision, that's when the numbers make the most sense. Before then, there's still absolutely planning you can do and absolutely numbers to target and shoot for, but it's much more hypothetical than when you're just a little bit closer.
Are there any, for those retiring early, are there any common pitfalls that will derail that decision quickly? Does that make sense? Like, again, the market going down is something to be aware of, but are there any behaviors that people can maybe avoid to make sure that their nest egg or whatever their investments don't just go down to zero and now they're left with nothing?
Yeah. The biggest thing I see is people underestimating their expenses. And it happens a lot. We sit down with someone, we build a plan. Oh yeah, I can live on $5,000 a month or $10,000 a month, whatever the number is for them, right? That's a whole lot of money. I'm good. And we go through and we try our best, as we work with people to get as close as we can and look at their current income and make really good assumptions. But what they don't plan for that gets missed oftentimes are the one-off vacations and the cars. You need a vehicle. You need these expenses that pop up during your life that we are used to seeing them. So we build those into the plan for you. But for someone that's doing it on their own, they forget about those expenses. And that adds money to the bottom line of what you're going to need every year. And so I've seen it frequently where people really underestimate what they're going to pull. And that can have a huge impact, especially if you're retiring your first couple of years, you retire and the market goes down and you're locking in some of those losses and you're pulling more than you need to, you can run into some issues.
Yeah, I mean, you talked about cars. It seems like upgrading a house, maybe kids are moving back in or grandkids. I know that with my family, my mom couldn't say no to her grandkids, right? And so whether that was a horse or some other thing, like it didn't matter. She was going to do it for the kids. So I think that's an important thing. Is there anything we missed on something that people should be aware of as they're retiring early as we've gone through this conversation?
No, I think that this is a really good start. So again, it's more complicated than just a quick conversation that we're having here today. There's so much more that goes into it. So if anyone has any questions and they want to talk through some things that are on their mind, we're going to drop a link below. Contact me. I love, let's take a half-hour phone call, and I love to hear about people's circumstances and point them in the right direction and see if there's any value you can add, because there's definitely a lot of really complicated decisions that come up when we start discussing retirement, especially early retirement. So don't be afraid to ask those questions and find people to help.
I think that's so beautiful because I have this fear of looking stupid all the time. And so sometimes I don't ask questions because I don't want them to realize how little I know on a certain topic.
Mm-hmm.
And so we interact with that a lot on the Medicare space. People will come in and they want to talk about Medicare. And we help doctors, hospital administrators. Medicare is a whole different language. And so we can't help if we don't know what's going on. And we can't help if we don't know what you don't know. I think the other thing that people are afraid of is being sold something, right? They're trying to be pitched or sold. So what I love about the concept in our conversations here is call in, interview your advisor, whether it's you or anybody else. Interview the advisor. What value are they going to bring? What is it going to cost me? And then how is this going to eventually help my life? And it's not going to cost you to call and ask what's going on.
No, and I do firmly believe that you should be able to have a 20-minute call with someone and get some basic answers to your questions without feeling like the need to commit, to something long term. So definitely, again, it goes back to finding some good people to talk to, interview them, ask the questions, and make sure that you feel listened to.
One last thing, and then we'll let you go. When they come to that phone call, if somebody reaches out to you, what should they have prepared going into that to make that call the most efficient for them? And again, so that you can build a picture real quickly around what's going on.
Yes. So I love, the first place that I want to start is by creating a balance sheet. So if you have a general list, and it doesn't have to look pretty, of where are my assets at right now, what type of accounts are they in, where are my debts, and where are my expenses, those three things can get us a lot farther than you would think in a conversation. So if you can pull together as much as you can on your assets and your expenses, then from there we usually can get a really good starting point we might not map out your whole retirement plan, but we usually can at least give you some action items for the next couple of years that you can start chipping through.
That's awesome. Jaeden, thank you so much. Again, it's Adams Wealth Advisors. We'll have links in the description that you can go and connect with her or her team. And appreciate you having you on.
Love it. Thank you so much.
Yeah.